Understanding purchasing power, implications and factors. Purchasing power is a fundamental concept in economics, representing the value of currency in terms of the quantity of goods or services it can acquire. This concept has profound implications for consumers, businesses, and national economies. As we delve deeper into purchasing power, we'll explore its relation to inflation, the role of central banks, and its global significance. What is purchasing power? Purchasing power, often referred to as buying power, quantifies how much a single unit of currency can buy at a given time. For example, if a loaf of bread costs $2, a single dollar has 50% of the purchasing power necessary to acquire that bread. When prices rise, as they tend to do over time due to inflation, the same dollar can buy fewer goods or services, thereby diminishing its purchasing power. Key takeaways. Purchasing power is a measure of what can be bought with a unit of currency. Inflation is a crucial determinant that erodes purchasing power by increasing the price of goods and services. Central banks strive to maintain purchasing power stability through interest rate adjustments. The role of inflation. Inflation, the gradual increase in prices across an economy, is the primary driver behind the erosion of purchasing power. For instance, if inflation rises to 4% annually, it means that the same basket of goods that costs $100 today will cost $104 next year. This decrease in value implies that unless income levels rise accordingly, consumers will find it increasingly difficult to maintain their quality of life. To illustrate this further, let's consider a hypothetical scenario. Imagine you've been paid a fixed salary of $50,000 per year for 5 years while inflation rises steadily. Despite your unchanged income, your ability to purchase goods diminishes as prices increase. Thus, inflation acts as a silent thief, reducing your purchasing power over time. Measuring purchasing power, the Consumer Price Index, CPI. The Consumer Price Index, CPI, is one of the most significant indices used to measure changes in purchasing power. Compiled by the U.S. Bureau of Labor Statistics, CPI tracks the prices of a selected basket of consumer goods and services, from transportation to medical care. It serves as a reliable indicator for changes in the cost of living, inflation, and by extension, purchasing power. How CPI works. A base year is established, and the average price level of the basket of goods in that year is considered 100. Changes in prices are compared to this base year to discern if inflation is present. Global context, purchasing power and economic stability. Globalization has tightened the interconnections between different economies, meaning that shifts in purchasing power can prompt worldwide economic ramifications. Countries continuously adjust monetary policy aimed at controlling inflation rates and maintaining stable purchasing power. In the age of interconnected markets, events like the European debt crisis or the global financial crisis of 2008 highlight how purchasing power loss in one area can spread and affect economies globally. In 2008, for example, central banks worldwide employed aggressive measures, such as lowering interest rates and initiating quantitative easing, to restore economic stability and protect purchasing power. Purchasing price parity, PPP. A related concept is purchasing price parity, PPP, a theory that seeks to determine the relative values of currencies based on the idea that identical goods should have the same price when translated into a common currency. For instance, if a hamburger costs more in one country than another when adjusted for exchange rates, that discrepancy may indicate currency misalignment. The World Bank regularly publishes data that uses PPP to compare the relative purchasing power of economies globally, allowing for meaningful comparisons of income levels and living standards. Loss and gain of purchasing power. Changes in purchasing power can occur due to various factors. Loss of purchasing power, triggered by inflation, increased taxes, or economic downturns. Consumers may find their savings purchasing less over time. Major historical events illustrate this, notably Germany's hyperinflation in the aftermath of World War I, where excessive currency printing led to a devaluation of the German mark and a collapse in purchasing power. Gain of purchasing power. Conversely, purchasing power can increase due to reduced prices, deflation, or technological advancements that lower production costs. For example, laptops that once cost $1,000 might drop to $500 due to innovations in technology, effectively increasing the purchasing power of consumers. Investing in a low purchasing power environment. For investors, the preservation of purchasing power is critical, particularly for retirees relying on fixed incomes. Strategies such as allocating investments towards assets that often outpace inflation, like equities, real estate, or treasury inflation-protected securities, TIPS, can help mitigate purchasing power risks. Special considerations. 1. Debt securities. These can be susceptible to inflation, eroding fixed interest payments. 2. Commodities. Often maintain value during inflationary periods, serving as a hedge against currency devaluation. 3. Global tracking. Investors must pay close attention to global economic indicators, as changes can impact domestic markets. Conclusion. Purchasing power serves as a critical economic barometer, influencing everything from daily consumer decisions to expansive financial market movements. Understanding the dynamics of purchasing power, especially in the context of inflation and central bank policies, helps individuals and investors navigate the complex economic landscape more effectively. By actively monitoring purchasing power trends and adopting appropriate investment strategies, one can work towards safeguarding their financial well-being against the corrosive effects of inflation.